The issue is here, do you get off the train? In a bull market, you ride the train. Do you get off it and try to trade it and try to scalp and try to get lower? Try not to, don't get pretty here. It's you ride the train, you buy the dips.
Welcome back to Metals and Miners. I'm your host, Gary Bohm. Today, we're diving deep into the exciting world of precious metals, mining, and current market opportunities. I'm thrilled to introduce Don DURRETT, a seasoned gold stock analyst, investor, and the founder of goldstockdata.com. With a sharp focus on the gold and silver mining sector and decades of experience tracking gold and silver markets, Don is known for his data-driven insights and knack for spotting undervalued opportunities in the resource space. Don, it's an honor to have you back on Metals and Miners. Welcome to the show.
Yeah, Gary, thanks for having me back.
All right, so Don, you've got decades of precious metals and mining experience, like I mentioned. You've been analyzing the miners for years. You created a website to analyze miners. You even wrote a book on the subject. While no one knows the length or the scope, the precious metals are 100%, without a doubt, in a new bull market. What do you hope for those tuning into our conversation today that they will walk away with after listening to this conversation?
Yeah, that's a good question. You have a lot of different people in your audience, so everybody has a little bit of different reasons to come here, different reasons to listen to me. I suppose, probably the best takeaway is for somebody that doesn't own, that hasn't found the gold and silver miners yet, and that this is a paradigm shift, and that it's probably, if you do own, if you are an investor, you probably want to get some exposure to gold and silver miners here, because we're kind of in early innings, and the upside potential on these stocks is very significant, so you're going to kind of miss the boat if you don't get in. This isn't really a can it happen situation. This is a going to happen situation.
Okay. All right. So global stock markets, I think in our pre-conversation, you were beginning to allude to this, but global stock markets have reached a staggering 143.8 trillion in market capitalization. It's a record that really defies all historical precedent. Since the lows in April, a mind-boggling 33.8 trillion has been added to global equity values. That's a 31% surge in 5 months. By many metrics, the U.S. stock market is in all-time bubble territory. It is not currently showing signs of a sharp decline. However, the question is, what happens if even a tiny fraction of the capital that exists there rotates into the microscopic gold and silver mining space during either a decline phase like 2000 or 2008 or a stall out phase like the late 1960s, early 1970s in the stock market?
Yeah, that's what I meant by this isn't can happen, this is a going to happen event. This is a lot like 1927, 1929 kind of setup, but history's going to rhyme here. So what's happened is the markets are just uber overvalued. You mentioned the 143 trillion globally. I didn't know that, but it's 63 trillion in the U.S., which is more than twice GDP. And so these overvaluations are at historical levels. They're not tenable at all. They're currently trading at 5 times book value, 3 times sales. They're like double what they should be. It's been like this for more than a year, this overvaluation. So we're really late in the cycle here when this thing really finally stops going higher. I thought it was going to crash last year, and it didn't. And the reason why it hasn't crashed is because of this not global, but U.S. fiscal dominance, where we have a $2 trillion deficit. So that $2 trillion deficit is just they're just borrowing money, spending excess cash, and keeping everything liquid and keeping things going forward. And the 401k money just keeps going into the stock market, keeps pushing it higher. People are chasing returns, but it's a bit of a fool's errand here, because when this thing does turn south, a lot of people are going to stay in the market because they have this normalcy bias that since 2008, 2009, every correction has been a V-shaped recovery. We definitely had that back in April. So people are going to stay in the market and just get really hurt, because we're not going to, this particular recovery, once it's, isn't going to happen, I don't believe. It's the reason why I don't believe that this is a normal business cycle, if you will, is because the U.S. has been living off of debt since the 1980s. In 1980, we had less than $1 trillion in debt, less than $1 trillion. We didn't have a debt problem, but when Reagan got out of office, it was 2.7, and it's been off to the races ever since. And now we're at 37, adding $1 trillion every 6 months. And so that's what that fiscal dominance is. The government is basically locked into spending. The big beautiful bill, they didn't cut anything really. It was really a spending bill. That's why Elon Musk got so upset at the end and had a falling out with Trump, because he's like, that bill doesn't work. That bill is just going to lead to a big problem. He's absolutely right. But the problem is, politically, it's untenable to try to fix that problem, that spending problem. It's not politically tenable to do it. So we're heading into this really bad situation here, where the Fed, and I've said this, the Fed really doesn't have any good choices. So when Powell pivoted in August, and August is really when the miners, the bull market in the HUI, which is miners index, when it really kind of began a bull market. And I say it's a bull market because the miners started outperforming gold, outperforming the markets. Like gold's up 45% for the year. The miners are up even more. And so you mentioned this, we are in a bull market, and gold, silver, the miners. But the last thing that's necessary for these miners to really do well is for the stock market to stop going higher. You talked about the rotation. So we don't need the stock market to crash, but what we need as investors, gold and silver miners investors, is we need the stock market to stop going higher. And once that happens, you'll have rotation, because there's about 20% of U.S. stock market, about 18 to 22 trillion dollars, is foreign money. And that foreign money is hot money. They're here to make money. That's the only reason their money is in our stock market. There's only one reason, is to make money. And so if our stock market stops going higher, they will rotate out. And it's a lot of money. $20 trillion. It's a lot of money.
Okay. All right. Yeah. I mean, you've said a lot of different things there. There's a lot of, positive and correct and accurate things that you're talking about. I want to ask you, let me ask you this. All right. So Don, the Fed lowered the federal funds rate last week, and long bonds went higher. It shocked a lot of people. The Fed has also indicated that they have 2 more rate cuts for this year, some for next year. Then in May of next year, President Trump is changing out the Fed chair. He's replacing Jerome Powell with someone who aligns with him to have significantly lower rates. I mean, Trump has called for 300 basis points in rate cuts. So clearly, lower rates are coming. Many point to the trillions of maturing U.S. debt that has to be rolled over as the reason. But whatever the case, with the bond market being in a bear market for several years, and clearly investors want to be paid more to lend long-term to the U.S., is gold in the process of becoming the only safe haven in town? Like, are we starting to get to the point where all roads are now going to be converging and pointing to gold?
That was really always the outcome for people that kind of analyze this from a holistic standpoint and kind of connect the dots. The only reason I own gold and silver miners, it's not because I like gold and silver mining. It's a terrible business. The only reason I own these is exactly what you said. All roads lead to gold, because it's the only place you can hide if the U.S. bond market fails. And I believe the failure of the U.S. bond market is inevitable. So it's a long-term trade. It's a one-time trade. I'll sell. I've been collecting miners since 2004. So I was very early. I thought it could crash as early as 2012, somewhere in there, but it didn't. We got into MMT where they just started just printing money, and they.
I'm surprised you don't have more gray hair than you do.
They added a decade to this whole. They pushed it out another decade, basically using MMT, but it was always going to be this way. It was always going to be the U.S. bond market failing and the U.S. dollar. So U.S. treasuries are really kind of the foundation of the global economy. When you talk about global reserves, they don't hold dollars for global reserves. They hold U.S. treasuries. That's kind of what they're holding on their balance sheets. And if the dollar goes down, if the bond market goes down, treasuries going down, the dollar's going down, all three go down. And if those three goes down, really gold is not the only place to hide, but it's one of the better places to hide. I mean, up 45% this year, right? And that's not a good thing. I always knew that I was going to win, but I also knew that people were going to lose. And a lot of people are going to lose really bigly, and this is a really ugly transition point. In my lifetime, the Fed has always been, kind of the all powerful. They could fix any problem. Now that's changed. When Powell pivoted at Jackson Hole, you knew that something was broken, because he shouldn't be pivoting here. He should be fighting inflation. But he said, when they had the Fed meeting last week, and he said, I can't do both. I got to do one or the other. And he basically said the obvious thing out loud. I can't fight inflation and fight unemployment at the same time. I can only do one or the other. And we have to do the one that we think is the most, precarious. And so basically what they're saying, but the irony of all of this is that the one that's the worst is inflation, because inflation is what destroys your economy. And so you can live with unemployment. You can have a business cycle. You can live with that, but you can't live with the destruction of your financial system, which is what inflation does. So Powell is basically saying, we're going to gamble. We're going to gamble that inflation goes away, and we're going to fight unemployment. But simultaneously, the one thing he didn't say, which I'm saying out loud right now, is by not fighting inflation, he's risking the entire U.S. economy. And I really do believe that by what he did in August and September, what those choices that he made, is literally the undoing of the U.S., not just the U.S. economy, but the United States of America.
Let me ask you this, Don. Don, let me ask you this. So there's been, in our first 13 minutes of discussion, there's been a pretty significant focus on the challenges that are underpinning the economy, both the United States globally and the financial system. Central banks have been buying record amounts of gold the last couple of years. There are and that's what's driven up the price of gold initially. But now there are people jumping on board and individual investors. There's also banks like Morgan Stanley who are now coming out proposing a 60-20-20 portfolio instead of a 60-40. So banks are now starting to get behind this. Presumably there are hedge funds that are starting to come on board, et cetera. We're seeing the gold price move a lot faster. There are approximately 60 million millionaires and billionaires worldwide. 60 million. That is a boatload of people that will want to protect their assets with the markets at all-time highs if the markets show signs of cracking or stalling. The sheer number of wealthy people globally that will likely be willing to buy gold at whatever dollar value, say between 5,000 and 15,000, to protect their wealth and portfolios, is going to blow people's minds. Your thoughts?
Yeah, the first thing that comes to my mind is the reason they're doing it. The reason, I mean, for Morgan Stanley to go 60-20-20, I mean, that is insane. I mean, literally insane. I could get 60-30-10. 60-30-10 to me would be pretty crazy. I mean, the average investor doesn't own any gold at all, and you're telling them to go all the way to 20%. I mean, it's insane. So even if they would have done 60-30-10, that would have been kind of off the charts, right? But the reason they did 60-20-20 is they're starting to realize what people like me that are kind of outside kind of the mainstream, who kind of analyze it from a historical perspective. We don't care about the short term. We care about the historical precedents, everything that's happened, that's led to this point. They're starting to connect the dots, and they're starting to realize that if the U.S. economy, if this isn't a normal business cycle, then you're getting a paradigm shift. And that's what I've been saying. That's what's coming here. This is not a normal business cycle. This is a paradigm shift. This is basically what's going to happen here is degradation on a massive level, where the end result is some type of a reset. Now, we don't know what the reset's going to look like. We don't have a clue what the reset is going to look like. But the one thing that we do know is that it's not going to be healthy for the U.S. economy. This is a surrender situation. The U.S. Treasury and the Fed are going to surrender. Now, what are they going to surrender? They're going to surrender the living off of debt. Think about that. So this is how it's going to unfold. And once the recession begins, the Fed and the Treasury are both going to try to restart the economy with a normal business cycle. So they're going to start printing money. But the problem is, it's going to be just like Japan. It's going to be like pushing on a string, because they're not going to want to create inflation. Remember, I said inflation destroys a financial system, and they know this. So they're going to print a little bit here, but it won't work. And then they're like, what the hell do we do now? It's almost identical to what happened to Japan. Japan, they had a lost decade from 1990 to 1999. Nothing they tried worked. They kept trying. They tried this, they tried that. Nothing worked. It's going to be almost identical. But the problem is that our economy is so over-levered that you're going to start seeing bankruptcies. Like we have like 20%, at least 10% of the S&P 500 are zombie corporations. And in the entire, and then if you bring in all the small businesses throughout the U.S., it's about 20% who are literally not making money. And so you're going to have bankruptcies left and right. Then you're going to start seeing regional banks close. And that's kind of the scenario that's going to unfold here. And when so that's what I said, this isn't fun. This isn't good. Gold going up is not good. It's not good at all. And so when this starts happening, exactly what you said, those millionaires are going to run to gold. A lot of them will run to gold. They'll also run to crypto. They're going to run to these assets that do not have counterparty risk. And ironically, we're going to have deflation in assets. But the one asset that's not really going to deflate is gold. So gold is going to be, a good place. So stocks are going to go down. Bonds are going to go down. Assets are going to go down. Paintings, yachts, cars, jets, all that stuff's going to go down. So gold's going to become very, a lot of demand for gold. Absolutely. So you see this like a 1930s redo where, if you were able to own gold during that time, obviously it was confiscated in 1933. But if you were able to own gold, you would see gold go up dramatically. And of course, if you own the miners like Homestake Mining at the time, you would have realized 600% gains and a massive $50 dividend in the middle of the Great Depression. Yeah.
So this is how you see it.
Yeah, absolutely. The miners are going to be, a lot of miners will be 5 and 10 batters, just like Homestake. Now, it's history's going to rhyme, but we're not going to have a depression like we had in the 30s where you had 25% unemployment. We're not going to have that. The reason why we're not going to have that is because of technology. So technology allows companies to be very, very, they can get by with a lot less, very productive, if you will. So you're not, Home Depots are going to stay open, UPS is going to stay open, Walmart's going to stay open. We're not going to have a depression. But what it's going to be is that old saying that a depression is when a recession is when your neighbor's unemployed. A depression is when you're unemployed. Yeah. So people, that's where it's going to get ugly. The ugly part is when you lose your job, you won't be able to replace it. That's the ugly part. But we're not going to have 20% unemployment rate. It'll probably be like 10 to 15%, something like that. It'll be ugly.
Very substantial.
It'll be substantial, but it won't be, it won't be like 1930s where nobody has a job. We're not going to have that. You're going to have winners and losers.
Okay, so I have a ton of other questions. I want to stay focused on the miners, but with this particular issue, just give me like a 30-second answer on this particular issue. If we end up with a 10, 12, 13, 14, 15% unemployment rate, with AI advancing, do you see a difficulty this time around with those folks getting back into the workforce versus previous unemployment spikes?
Oh, absolutely. You lose your job and you might not replace it at the same level. It's like, forget about it. You're just not going to be able to replace your job.
Okay, so that's
the only chance you have is to move. But the city you're in, it's like that's done. It's not coming back, kind of thing.
All right, so that's a conversation for another time. But that's a conversation for another time. But I definitely, based on your comment, I was curious, where you thought. A lot of the guests that I have feel very similar, by the way. But let's go back to the miners here. The miners have moved a ton over the last 6 months, and they have spiked really hard since early August. Many who have been burned in the space in 2011, 2016, and 2020, they're now very nervous about how high things have run. I know you've seen this. I know people are saying these things to you. In your opinion, is the run for the miners nearing an end?
It just started in August. It's 2 months old. It's going to last 2 to 3 years, this bull market. It started really when silver got above 40. In a bull market, you really don't have to worry about corrections. The reason why you don't have to worry about them is because they're short-lived. The only time your portfolio gets damaged is when you have a deep correction and it's prolonged. So let's say the stock market goes down 20, the HUI, the miners go down, say 20% or more, 25%, and then they stay down for, say, 90 days. In that scenario, your stocks are going to get hit because the companies will get paranoid and they'll raise money at the lower rate. They'll raise cash at the lower share price, and your portfolio will get damaged. But if it goes down 20% and gold only stays down for 4 to 8 weeks, the odds of your portfolio being damaged is very low. And so,
would you speak into? I know you've seen this where many analysts are pointing to oversold readings in the RSI and the distance that the metals are away from the 200-day moving average, how stretched they've become. And they're saying, look, 2011, 2016, 2020, this is what's coming for the metals. It's going to be the same thing. I know you've seen this. So can you speak into why this time?
We're in 2009 here. We're in 2009 where we just broke out. And they're basically saying either take profits or get out of the way. The RSI, maybe it will correct down, like I said, 20%. The issue is here, do you get off the train? In a bull market, you ride the train. Do you get off it and try to trade it and try to scalp and try to get lower? Try not to, don't get pretty here. It's you ride the train, you buy the dips. You said it at the very early of this podcast. You said we're in a bull market for miners, and it's obvious, and it is obvious, and we are in one, and it's going to last. And so, just because there's two mistakes that people make here. Number one is they take profits too early. people have already been taking profits already, and we're not even at $50 silver yet. We're at $40 silver, 43, and people are taking profits. It's kind of ridiculous. You shouldn't even take profits at $50 silver. $50 silver is really a nothing burger just because it's an all-time high. But the last time we were at 50, it was in 2011. So adjusted for inflation, it's 70. So you really shouldn't even think about taking profits until we get to 65. And once we get to 65 silver, then you reassess and see how strong the fundamentals are. Like today, the fundamentals are uber bullish. For instance, we don't even have all of the ducks in a row yet for the miners to do well. The last duck, if you will, in the row is the S&P 500. It's still at an all-time high. Miners do well when the stock market does poorly. If you go back to the 1930s, homestake mining did unbelievably well because the stock market was doing poorly. 1971 to 1980, the stock market did poorly. The miners did unbelievably well. 2000 to 2011, same thing. So we need the stock market to do poorly, and it hasn't even done poorly yet. So this thing really hasn't even started, and people are taking profits, or people are afraid of the RSI.
Okay, that's a
Now,
great point.
If you're a trader, a good trader, not an average trader, if you're a good trader, then yeah, take profits, wait, do it, in and out, in and out, in and out. But the average investor, ride the train all the way to the top, take profits on the way. I won't take any profits before $65 silver or before $4,500 gold. Those are like my minimums. And once we get to those levels, I'll reassess and see how bullish I still am. I might take very, very few profits at that level. And then from that point forward, 4,600, 4,700, 4,800. As we slowly go higher, then you take profits. I'm expecting to take quite a few profits around $5,000 gold. That's the kind of an area that I'm looking at where I'm going to take a pretty good chunk off the table, maybe a third. And then, as we go higher, 5,200, 5,300. But we are early innings here. This thing's 2 months old. It's way too early to be getting off the train, way too early to be taking profits.
You're coming through loud and clear. I appreciate your point there. All right, so oil. Oil is a huge cost for the miners. It has been trading in the $60 to $75 range for several years. It's been in the mid to low 60s for the better part of the last year. Gold and silver prices have had a substantial move higher, as we know, in 2025, and it's creating historically high free cash flow for producers. Q3 is coming close here to an end in a week and a half. Do you expect blowout earnings for the miners and a massive move higher during that time?
It'll continue to trend higher. Yeah, we're going to get a really good quarter for both gold and silver miners, and so they will all start to trend higher. I said for Newmont was trading at $30 back in February, and I basically said this is a bottom for Newmont. Buy to the bottom. It's not going any higher. My target's $300. And I showed a chart, and I said, look, it has to go back to 80 just to get back to its 22 cycle high. And it was trading at 30. And you talk about it was just ridiculously cheap. And now it's back to 80. So basically we're back to the starting line on Newmont. And so when those earnings come out, Newmont will probably be in the 90s, mid 90s maybe, but it's still got a long way to run. That's what I mean. We're early innings. Newmont is going all the way. It will go all the way to 300 at $5,000 gold. So we're still very early here. Now, as far as earnings go, and the miners, I mentioned this earlier. The big moves in the miners are ahead of us. So I don't see silver getting to 50, and I could be wrong here, which is the all-time high, until the stock market stops going higher. I think that could easily happen here, maybe in September, but definitely in October. I'm expecting something to break here in October as the markets start to wake up to the fact that the Fed is trapped here, and the Fed, basically the Fed's not going to be able to prevent a recession. So once the market starts to recognize that it can't prevent a recession, I think that's when the market starts going lower. And that's when the miners initially will go down, initially with the markets. But I think they'll only go down about 20%. I think gold will go down about 10%. And that's about as far down they'll be able to push gold down, about 10%. But then it almost immediately will turn around and go back up. And when it goes back up, that's when these miners are really going to rip.
Okay. All right. So just one more question on the oil. Since oil plays such a huge role in the balance sheet for and earnings for these producers, how high can oil go before investors should really take note of the likelihood of earnings compression rather than earnings expansion that the miners are currently enjoying?
Yeah, so what you want to do is you need to look at all the factors that are pushing gold higher. And when you look at all those factors, they outweigh gold by such a huge amount that oil is normally what you're saying actually holds water, but it actually doesn't here. Because the reason why it doesn't is because gold is outperforming the market at such an extent that the margins are so significant. And it's going to be the only place to really make money. That even if oil goes to, in 2026, goes to 100, 110, it's a nothing burger. And then in 27, even if it goes to 125, it's still a nothing burger. Now, how in the hell, you asked me, Don, how in the hell is that possible? How can oil, or let's go next year, 110. Oil goes to 110 next year, and you're saying it's a nothing burger. The reason why is because I think gold's going to go somewhere between 4,200 and 4,400. If gold continues ripping higher, oil will not be able to slow down. The margins are already very high, and oil won't be able to basically make inroads on those margins. Now, what are these factors that are pushing gold higher? That's what people really need to wrap their head around. And what people aren't wrapping their head around is this paradigm shift that's happening globally. The global South, which is slowly and steadily moving away from U.S. treasuries and U.S. dollars as reserves. Gold right now has higher reserves than dollars. And so as the global South moves away from treasuries, the U.S. is basically trapped. We don't have any foreign buyers of our bonds. This is massive. This is huge. And the U.S. is trapped in this fiscal dominance, which I just mentioned, where we have to borrow, $100 billion every month, and we have to spend $1 trillion on interest payments. These are much more fundamental problems than oil. Another one is the cost of living problem in the U.S. The U.S. is 70% consumer spending, and 50% of Americans can't pay their bills. So America appears, GDP is at 3%, but it's an illusion because they count GDP as part of GDP. If you didn't count the deficit as part of GDP, we wouldn't have any growth. So the consumers basically, half of the consumers in America are basically broke. That's not getting fixed anytime soon. So when you look at these bigger factors, oil is really a nothing burger as far as slowing down gold, slowing down the returns of the miners. I'm expecting 110 oil next year. I'm expecting 125 oil in 27. Am I expecting gold not to get to 5,000? Absolutely not. As a matter of fact, my target of $5,000 gold is probably too conservative. I think we could probably get to 6,000 or 7,000. And so if you get to 6,000 or 7,000, what does it matter what oil does as far as earnings for the miners?
Okay, so there may be a lockstep move, so to speak, with gold still outpacing oil on the way up, and that'll continue earnings expansion over earnings compression. All right, so portfolio managers, we talked about this earlier, they're simply just not allocated to precious metals widespread. They've been polled, and more than 70% of these portfolio managers hold 0 to 1% in gold. More than 10% hold no gold at all. And out of the remaining 30%, something like 27% hold less than 5% in gold. It's really astounding. So they still prefer to invest in AI, big tech, and maybe literally anything else than the miners. The Western investor, they are still unbelieving in what's happening here. They're skittish. They're relatively non-existent compared to their overall size when it comes to the precious metals. They still have a hard time believing that this run is going to keep going rather than believing that it's topping. So they either don't want to buy, or as you were saying earlier, many of them are already exiting some of their allocations or all of their allocations because they believe that this run is over. This mentality is creating a massive pool of investment potential to still move into the precious metal sector. Your thoughts on that? How do you view it?
Yeah, we are very early in this as far as who's going to buy mining stocks. More people will buy mining stocks that currently own none than the miners people that currently own them. So we're very early in this cycle. Like I said, it's only this thing's only 2 months old. Until you got to August, nobody cared about mining stocks. They really didn't. Now, one thing was fascinating. You talked about only people that run money only hold 0 to 1% in their portfolios, and
70% of them, yeah.
Yeah, and 10% hold zero. This is a fascinating statistic. From August to September, the number of shares in GDX went down. It's mind blowing. So basically, people were selling GDX.
That's what I'm talking about here.
The actual number of shares went down, and gold didn't go down. Gold kept going up. GDX was going up, and people were taking profits.
So what does that tell you about the psychology here?
Well, it tells me that, see, people have a normalcy bias. People believe that the U.S. economy has this superiority where we're the best economy in the world and we're always going to be the best economy. And the U.S. is the best innovators. We allocate capital the best, and there's nothing to worry about. You have a business cycle. Every business cycle is short-lived. So it's this mentality that the U.S. economy is vibrant. It's vibrant. I'm going to stay fully invested. I am going to buy, mining stocks, and I'm not going to buy. I'm not going to speculate. Here's the key takeaway here: mining is speculating. It's not investing. And the reason why it's speculating, because it's a really strange business. Mining companies don't have customers. They have buyers. They don't have competition. Newmont and Barrick don't compete against each other. They don't. If they take gold out of the ground, and then they find whoever wants to buy it, and there's plenty of buyers. They have no customers, and they have no competition. It's a weird business. And then on top of it, their profit is all predicated not on how they execute, not on how they run their business. It's all predicated on the price of gold. It's a strange business. So all you're doing is speculating. The reason why I got into gold and silver is, number one, it's going to benefit by economic insanity, which is what we've been living on. Basically, trying to grow an economy through debt is insanity. If you do any research on this, you'll find the Austrian economics basically says this is fantasy land. You can't do this. And if you recognize that the Austrians are right, then you kind of buy these miners because eventually it's going to work in a big way. But the other reason why I got into gold and silver is because of the leverage. So if gold and silver go up, you make baggers. I don't even invest in anything that's less than a 3-bagger. I don't want to touch it. And even the ones that are 3-baggers, the only reason why I buy them is because I think they're going to go to 4 and 5. And I'm diversifying. But most of the stocks that I buy are 5 and 10-baggers, most of them. My sweet spot is to find a company that I think has solid 5-bagger potential with 10-bagger upside. 10-bagger upside. I mean, that's what I'm after. It's total speculation. And so Wall Street is like, that's insane. All I want is a 20% annual return. And this guy's going for 10-baggers? So it doesn't, it doesn't, sink into their head. And then the other thing that's difficult with mining stocks, it's really difficult to understand it. When I got into this, I didn't really understand it for at least 2 years. I mean, at all. I mean, I was kind of, for the first 2 years, I'm in the dark. I'm just, fumbling and bumbling around trying to figure it out. And it really takes about 3 to 5 years to kind of understand what the hell you're doing as far as picking a stock. It's hard. And so Wall Street, they don't train their people. They don't train their people to understand gold mining companies. So none of them have a clue. And we see this over and over again with their allocation. If you go and you look at some of these allocations, I mean, the people that are in the know, we just laugh. It's like, you got to be crazy. That's your allocation? There's one I want to talk about, but I told the CEO I wasn't gonna say anything bad about his company, so I won't mention that particular ETF. But they basically have an allocation that's just ridiculous. I mean, it's just laughable. And that's kind of what you see in this business. You see people that really don't understand it, if you will, kind of making calls. It's like.
So the overwhelming majority of the gold and silver mining stocks have really moved quite a bit over the last couple of months. Don, is there a current gold or silver mining stock that has not explosively moved yet that you're excited about moving forward? Like a hidden diamond in the rough, so to speak?
Yeah, there are many. There's a lot of stocks that are trading, way undervalued, if you will, and they're not going to stay way undervalued. There's quite a few of them. One that I'll mention is Jaguar Mining. So I went to Beaver Creek and they have a new CEO, and I really liked him. And he basically laid out a 3-step plan of how he's going to grow the company. Jaguar has always been a very conservative company. They've never spent very much on exploration. They've never tried to do M&A. They just plug along. And this new guy comes in and goes, oh, no. I'm going to drill very aggressively. So his exploration, he's going to try to find 3.5 to 7 million ounces. And he's already got a plan for how he's going to expand production over the next 5 years, and he's going to do M&A. And they have 3 mills that all have 2,000 ton per day capacity, and they're only using 1,000. So he's going to go from 1,000 to 6,000. He's going to fill all those mills up. He's going to take production. He's currently at 40,000. He's going to take it to 200,000 ounces. And then he's going to do M&A. So Jaguar is one of those ones that's kind of silly cheap. Another one that is we see a lot of this in these development plays. These development plays are just, so Jaguar's a producer. Development plays, Next Gold Mining in Canada, they have 2 3 million ounce projects. This happens all the time in mining. And the investors will only give them value for one. They'll pretend they don't even have a second project. So their Goldboro project, which it's going to be fully permitted in the next quarter or two, all by itself is a 10-bagger. And it's in Canada. It's in Newfoundland, I think it's in Nova Scotia. That project alone is a 10-bagger. And then they have another one called Goliath, I think is in Ontario. Add another 10-bagger to it. And everybody's ignoring it. But those are 2 stocks that are just kind of ridiculously cheap. Another one that but is a little bit more risky, but I'm mentioning it because I really like it, is Talisker Resources, British Columbia. They were only supposed to mine next year in 26. They were only supposed to mine 30,000 ounces. So, and then the year after that, they were supposed to get to 50. So no, it was basically a slow ramp up. But it's a big mine eventually they were going to get to 150 to 200,000 ounces. But they didn't have the resources, and they decided they were going to go it slow. They weren't going to dilute their shareholders in the ground, which I applaud. But they got some financing, and they're doubling production. So they're going to go 50,000 ounces in 2026, and then 90 to 100,000 in 27. And then they're going to keep going from there. 150, maybe 200,000 ounces. And that one is silly cheap too. Those 3, I want to mention one more since you got me talking stocks. And that was my pick at Beaver Creek, which was 1911 gold. I've always loved this project. The reason why is that they were worth $1 billion. It's in Manitoba, 1911 gold. They were worth $1 billion in 2011, and then the gold prices went south, and they had to close the mine down and went bankrupt, I think, in 2013. And that mine has been sitting in care and maintenance for a decade. But the beauty of it is all they have to do is restart it. I mean, the gold was there, the mine was running, everything was beautiful, but they didn't have the gold price. Now the gold price has ripped higher. And once they restart that thing, I mean, it's crazy. I think I had it as a 50 bagger. That's how crazy the valuations have gotten. I had it as a 50 bagger at 120,000 ounces of production at $5,000 gold. Now they're only going to start out 60 to 70,000 ounces, but it'll grow from there. They will get to 120. I think they'll get to 120 by the end of 28. And at 120, today it prints about a 30 to a 35 bagger. So it actually gapped up. I made it when I pick of the conference. It gapped up. It was up 35% on Monday after the conference because I made it my top pick. But it's still uber cheap. I mean, it's gapped up. It's no longer a 50 bagger, but it still prints like it's a 30 to 35 bagger. But these are the kind of valuations that still exist out there. I actually had 26 picks out of Beaver Creek, and they were all potential 10 baggers, and they were all quality names. Really good projects. Those 26, you can go to my Substack and read them for free. Don DURRETT Substack. Just look for Beaver Creek. There's 2 articles there.
Okay. Appreciate you sharing all that mining stock intelligence with the group. This has been an incredible discussion. I want to welcome everyone tuning into this fantastic interview with Don DURRETT, founder of Gold Stock Data. Before we wrap up with our final set of questions for Don, I want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report. I'm also positive that you've been enjoying the conversation Don and I have been having. Please let Don know. Hit the like and subscribe button and leave a comment below the video. All right, so Don, would you please wrap up here by sharing a key takeaway that you want to leave with the viewers for them to keep in mind? It could be about today's economic, market, monetary, or precious metals and miners situation, and then let everybody know where they can learn more about your work and how they can connect with you.
Yeah, thanks for that, Gary. If you don't own any gold and silver miners, a good place to start is my book. So I have the only book out there that really explains how to understand the risk levels of gold and silver mining stocks. So if you don't own any, and if you own one, you should read the book. One thing I would like to say here is that I think it's important that you underplay exploration stocks in a bull market. And let me explain why. Exploration stocks, in many respects, are inelastic. What I mean by inelastic is that if a company makes a significant discovery, it really doesn't matter what the gold price is. As long as that discovery, because let's say a company has a market cap of 35 million and they have a gram meter hole of 500, let's say it's, 200 meters long by 2.5 grams. That stock's going to go up. It doesn't matter what the gold price is. That stock's going up. It's inelastic. And then they hit another one, 200 gram meter roll. That stock's going up. And that stock is just going to keep trending up, up, up. It's inelastic. And that's one of the reasons why people love exploration stocks. Because normally these miners are highly elastic. Like I mentioned, Newmont, the only reason why it really goes up because the gold price goes up. So a producer and a developer are highly elastic. Well, in a bull market, you want exposure to that elasticity. You want exposure to the stocks that are elastic. You want exposure to the stocks that are going to perform when gold and silver prices go up. So you want to downplay exploration stocks, have very low allocation in exploration stocks. You can always chase drill stories at any time because they're inelastic. But the producers, the good producers, the cheap producers, and the very highly undervalued developments, those are the stocks that are going to be your 5 and 10 baggers during this bull market. So you want to focus on those.
Okay. And the name of your book and where everybody could find you and connect with you.
Yeah, it has a black cover on Amazon. Just search for my name, Don DURRETT, and just look for gold and silver on the cover.
Okay. And how can everybody get a hold of you outside of that? Your website, your X account?
Yeah, so I mentioned Substack. So yeah, I have 63,000 followers on X, and I have my own gold and silver community on X, and it's pretty vibrant. I'm on there a lot, and so I interact with my followers, and that's a really good place to stay up to speed on what's happening in the minors. Also,
What's the
my
name?
forum,
What's the name of that?
Don DURRETT Substack. I mean X. It's Don DURRETT X.
And
And then
what's
my
the name of the
forum,
group? Yeah, the group.
oh, it's gold and silver, but you can find it. Just look at my profile. Go to Don DURRETT. Look at my profile. It's on there. And
Okay.
then my forum. I have 1,600 subscribers on my website, Gold Stock Data, and the forum is very useful.
Okay. Don, thank you for coming on to Metals and Miners again, for being so generous with your time and your analysis and ideas. I always love spending time with you and talking shop. Look forward to having you back on sometime soon. And everybody else, thanks for watching. I want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report.